Okay, well, good morning, everybody. How are you doing today? All right. Looking good? Good? Yeah? Yeah? So, you can tell me what we talked about last time. What did we talk about last time? Grace. I suppose you can look at your notes, but it's also really helpful to try to remember. Next week, you guys have a final. Never too early to flex that muscle. As she's looking it up, Quiana, do you want to tell me something that we talked about last time? Oh yeah, let's do that. Let's. In fact, that's what we ended on. So that's a great thing to talk about right now. The challenges of fiscal policy. Weaknesses. Remember one of them? Crowding out. Specifically, there were two types. Demand and supply. Grace, you got something for me now? What was another one? Yeah, we talked flag. There were 4 types of labor. Fiscal policy is slow. There were 4 types. And remember the last one? Implementation. It takes time to recognize there's a problem. It takes time to propose and pass a plan. It takes time to put the plan into effect. It takes time to put the plan into action. It takes time for the plan to have a full effect. What was another weakness? We had 2 more. Yeah. Real shocks. Why are real shocks a weakness? Exactly. The only way to fix a real shock is when you're a shock. If we have a real shock, we can't just throw government money at the problem and solve it. Fiscal policy cannot handle real shocks. And Francis, you got another one? I'll tell you hand up as well. Persistent deficit. What was persistent deficits about? Uh-huh. Yeah, exactly. Like, we actually had like 2 public choice stories play out here. One is on the crowding out supply side, that if you have more people, if you have people making these decisions that don't have an incentive to help the people who need the help, they have an incentive to defend themselves. We also had a public choice story play out in this persistent deficits issue, where if like people are spending money and cutting taxes to shift 80 to the right, and that's politically popular, right? People like money, they don't like paying taxes. The problem is, in order to pay off those deficits, you have to do the opposite. Cut spending and raise taxes. People don't like that, so we get this persistent deficit issue, right? Whenever there's a sort of ratchet effect, whenever there's a disaster, we're going to fuel the deficit, but no one ever brings it back. So we just keep piling and piling on the debt, and at some point, things are not going to go very well. But no politician has decided to care about that. That's future politicians' problem. So I added the persistent deficit thing because it does seem to be a bigger and bigger issue on my list. But both of these have public choice themes to them, both the supply side crowding out and the persistent deficit. So with all these problems, it seems like it would be really great if we had some other tool at our disposal in order to deal with recessionary gaps. And the good news is we do. And we call it what? Want to take a guess what's called? Yeah? Monetary policy. Like fiscal policy, monetary policy shifts aggregate demand. But it doesn't use government spending, instead it uses the money supply, and thus interest rates. Media describes it as the central bank changing interest rates. They're changing it by changing the money supply effectively. We're going to go into detail about how this is done. This is a change the framework, but we have to get a little background first. Now, in fiscal policy, who did the actual actions? Who was actually in charge? Who was actually in charge of fiscal policy? Liam. Well, that's a pretty big. Let's narrow it down a little bit. Let's say it one more time for Dina. No. So I'm talking about who does fiscal policy. So it is part of the government, but which part of the government? Yeah, Nick. The legislative branch, and where the president has to sign off on it, right? So it's Congress and the president who do these things, who pass and propose a plan. But that's not going to be the case in monetary policy. Who's in charge of monetary policy? Yeah, go ahead.
Bureaucracy?
Nope. Bureaucracy usually implements the fiscal policy plan. What? So the banks are going to play a role, but they're not going to be, it's a particular kind of bank. It's done by the, Grace? Yep, in the United States, it's Federal Reserve. More generally, it's a central bank. Now you might have been like, well, wait, didn't someone say banks? And I said no, and then I said central bank. Because the central bank in any country is not really a bank. The central bank in any country is more of an authority. Remember how we talked about fiat currency? What is fiat currency? Yeah.
Currency with no intrinsic value?
Mm-hmm. Yeah.
Yeah, not linked to
So where does the value come from?
full faith backing the United States government.
In practice, right? We are trusting that the government won't print a whole bunch of this money and make it worthless, right? Who decides how much money to print? The central bank. So every country with its own currency is going to have a central bank. There is a central bank of Japan that determines how much yen to put into the economy. There is a central bank of China, which controls the yuan. There is a central bank of Mexico, which controls the Mexican peso. European countries, the Eurozone countries, don't have a central bank individually because they don't control the currency. The European Central Bank controls how much euro's in. But Belgium, for example, doesn't really get that control. It passes on its monetary authority. That's why England, which was until relatively recently part of the EU, never joined the Eurozone. They wanted to maintain control of their own currency, the British pound. So there is a Bank of England, an English central bank, and there's a European Central Bank, but there's no Belgium. And as noted, in the United States, we call our central bank, what was it? The Federal Reserve. Often abbreviated as the Fed. So that's why we can't say the government does this, different parts of the government do different parts. Now, we got to get a little deeper. Just like fiscal policy, monetary policy has its own multiplier. Fiscal policy had the fiscal multiplier. So what do you think we call this one? The monetary multiplier. We're not very creative. But that makes it easy to remember. It's going to equal an equation, but in order to tell you what it equals, we're going to have to do a little background on what it means. Look. Just like the fiscal multiplier, there's going to be some change in real GDP as a result of doing stuff. And that is going to be divided by the initial change in M. Not in spending, but in M. M stands for money supply. Put more money in the system. Well, remember, what's the goal? If you put money in the system, banks will have that money. What do banks do with money? To make money, they lend it out. So, money in banks is lent out. Just like the government spends money, that money becomes somebody's income. And when you borrow money, what do you do with it? What do people do with money when they borrow it? They spend it, right? You don't borrow money to rub your naked body with it. You borrow money to spend it. Then, when that money is spent, if you go and you buy a car, or you go and you buy a house, or you go and you start a business, and you spend that money on equipment, some family or some company is going to get these big checks. What do they do with that money? They deposit the money. And money in banks is then lent out again. Around and around we go. So this is where we get that multiplier effect. Just like money spent becomes somebody's income, which is then spent again. Money lent out goes into a bank, which is then lent out again. Now, in the fiscal multiplier, we took 1 divided by what? 1 divided by what, Emily? For the fiscal multiplier. The thing that starts with M, that's right. Can we narrow it down?
It's 3 letters.
Okay, so we got 3 letters. The final is next week. Did I mention that? Yeah. Close. Marginal propensity. Marginal propensity to. MPF. Right now, remembering? Okay. In other words, the money travels from person to person, and we divide by the portion that the individual holds on to. And then the rest is passed on. Thus, the smaller amount that they hold onto, the larger the multiplier, because more is passed on. Well, similarly, when banks get money, they don't lend out all of it. Not all the money in a bank is lent out, just like not all the money that you get, you spend. Why is that? The question is, why is it that banks do not lend out all the money that's deposited?
Oh, because just in case someone wants to not deposit, but take the money.
Yeah, just to cover those withdrawals, right? So, in other words, and we call that amount, the reserve ratio. portion of money that is not lent out. In other words, it's kind of like saving for the individual. Yes, we're going to hold on to a part of it and then send the rest of it out to the world. Hold on to a part of it and send the rest out to the world. Just like the fiscal multiplier is 1 over what again, Emily? MPS, which stands for? Nope. We just said it. Marginal. Well, they got the same marginal propensity to save. Yeah. Just like a fiscal multiplier is 1 over the marginal propensity to save, MPS. That portion we will hold on to. The monetary multiplier is going to be 1 over the reserve requirement, the part that we hold on to, banks hold on to. And just like our fiscal multiplier, the bigger the multiplier, the bigger the AD shift. Because when commercial banks lend out money, that is money creation. And so you could argue this really should be like change in M instead of change in YR. Like what's the total change for money supply? But I want to kind of like emphasize that this is all about shifting aggregate demand farther to the right. And on the right, we have change in real GDP. So, but I think technically it's change in M. All right. Do we have any questions so far? Oh yeah, Grace, what's up? Reserve ratio. Okay. So a little bit about central banks. As mentioned, not really a bank. They are an authority. They regulate banks. They regulate commercial banks. You know, like normal banks that we think of. And they conduct monetary policy. Some countries use another country's currency. Like Panama uses the US dollars a lot. I think Nepal, I had a note here that Nepal uses, Nepal uses the Indian rupee. These countries do not get a central bank. They do not have control over their own currency. Thus, they do not get to do monetary policy. Okay. And they are just subject to whatever the other country does. So if the Federal Reserve is like, we're going to lower interest rates, and Panama is like, well, we have a lot of inflation. We would like to have higher interest rates. Tough luck. You decide not to have your own currency. You're using our currency, so you're at the win or whatever. So a lot of countries have their own currency. Zimbabwe had to switch to the US dollar because it just wasn't functional. But they switched back. I'll open that door once they figured things out. So typically that's the desire. As noted, the Federal Reserve has its is our central bank, and we call it the Fed. And it has, in the conduct of monetary policy, a dual mandate. By law, it must do these two very different things. Does anyone know what these two very different things are? Mm-hmm. Nope. In with respect to conducting monetary policy, it is responsible for keeping price stable. Exactly, keeping unemployment low. So it has statutory authority to step in and start doing stuff. If say inflation gets high, or say there's a recession, they can do stuff. And they're expected to do stuff. That is the purpose of the organization. Is their mandate as set by Congress. Keeping prices stable typically means fighting inflation. Keeping and shifting aggregate demand to the left. Keeping unemployment low typically means shifting it to the right. For example, during COVID, lots of government spending shifted aggregate demand way to the right. And we got inflation in the 22, 23. And the Federal Reserve had to say, oh shit, we gotta do something about this. Government isn't gonna fix the problem. The rest of the Congress is gonna fix it. We gotta do something. We have to. And so you might have heard the term soft landing during this time. You remember that term, soft landing? It's a lot talked about in the news. Nope, you do. Okay. What do you remember about soft landing?
It was the hope that they could bring down inflation and prices without having the market collapse.
Yeah, exactly, right? They wanted to bring AD back here without overshooting. And bringing AD all the way back here into recession land. They didn't want to do that. Shift it left, but not too far left. That's why I say that these are kind of contradictory things. On one hand, you don't want AD too far to the left because that's going to create unemployment. And you want to fix that. So if you're going to solve unemployment, you got to shift it to the right. But not shift it so far to the right that you have inflation. No, that's the problem too. If it's too far to the right, then you got to shift it back to the left. The balance between these two things. God forbid SRAS shifts to the left. Then you have both unemployment and inflation. And it's not really sure what the hell you're supposed to do. Okay. Now, let's talk a little bit about the organization. If you are not from the United States, there are various weird things about the United States that you have certainly noticed. And one of the things that surprises foreigners, but is totally noble to Americans, is when you cross into another state, what suddenly happens? What? Something changes. Yeah? Sometimes the time changes, but that's because it's a big country.
Like laws and taxes.
Yeah, right? The laws are different. And another way of saying the taxes are different is the laws are different, right? Because we have this system in the United States for federalism, right? We decentralize power, a lot of power among the states, right? For Americans, totally normal. For people from other countries, it's like, what the fuck is this? This is how you guys run your country? You have all these different patchwork of laws? Does anyone know why we have that patchwork of laws? You don't know?
Why we have different laws in the
Uh-huh.
because we're supposed to be so that's just
That's just how it works, right?
Yeah, like the states. The federal government has like a specific amount of power or
Mhm.
laws they can make, and then the rest of them can go to the states.
But why did we do that? Yeah, David?
Because people live like differently in different states.
Mm-hmm.
So, like, for instance, like, you get a driver's license at 14, like some, or a permit at 14, like some state.
Right.
Because, like, so, because you need like a permit to drive a tractor or
I mean, they didn't have tractors for far out of the country, but
oh,
that's a consequence, right? We have different rules in different states. Yep.
To balance the power of the government.
Balanced by the federal government, right? We started this country, and the founding fathers started this country because they didn't like concentrated power. And so they're like, we don't want to be a government of like one country. Like, we want to be lots of little countries working together. We really just don't like concentrated power. Right? We used to call this country before the Civil War these United States rather than the United States. We had this problem with the Articles of Confederation. Like, it was too weak because we couldn't like get an army together. I bring all this up because that tradition of decentralizing power, it passes even into the founding of the Federal Reserve, which was in the early part of the 20th century. Because we don't actually have a one Federal Reserve. That would be too powerful. What the hell are you doing? We're the United States. Damn it, are these United States. So we don't have one Federal Reserve. We have 12 Federal Reserves. Here's a map of the Federal Reserve. Technically, it's called the Federal Reserve System to reflect the fact that we have decentralized power among these 12 districts that they drew. Sometimes following state lines, sometimes totally not. Whatever. And the idea is within these banks, right, the San Francisco Federal Reserve regulates the banks that are in that particular system for San Francisco, for that district. You have heard me mention the St. Louis Federal Reserve. They're the ones that run the Federal Reserve Economic Database, as well as regulating the banks in here. And these, by the way, these black dots are satellite offices. And the idea is the Board of Governors sets monetary policy, but a lot of the day-to-day regulation occurs decentralized among these various federal reserves. Again, we like to spread out power. Okay. Any questions so far? Well, we also like to keep power in check at the Federal Reserve. We don't want it subject to a lot of political pressure. We've seen, by the way, what happens. We talked about that in class. What happens if a country is really doesn't have an independent Federal Reserve? That's what happened to Zimbabwe. Just keep printing money or you're fired. So the Federal Reserve is independent. And we have a couple of mechanisms to maintain that independence. One, members of the Board of Governors can be Board of Governors for 14 years. This term is so long, it is to help insulate them from political pressure. Because they can't get fired. A politician can't say, well, if you don't do as I say, if you don't radically increase the money supply to lower interest rates to get an economic boost in time for the election, then I'm going to fire you. Or I'm going to say, well, you could become, your term is up and I just won't nominate you again. Let me check this. I'll need that again later. So I'm just going to bring it up. Switching to black, it's holding up a bit more. Not only do they have 14-year terms, the Fed is self-funded. They own lots of treasury bonds. So it's not as if Congress can cut their funding. The Federal Reserve gets its money from Congress, but it gets its money from Congress because not because it has a line item in the budget, but because Congress is paying off debts. And the Federal Reserve just has lots of treasuries. The government owes the Federal Reserve lots of money because it's bought that debt. So when the government pays off an installment of that, they are also sending a big block of money to the Treasury, to the Federal Reserve. And the Fed can use that to pay salaries and so forth and run the operations. Plus, they can print money. 3. Now, during World War II, they wanted to sort of relax the independence a bit because they really needed funding issues for World War II. But in the aftermath of that war, they reestablished that independence. And the Treasury Fed Accord of 1951 formalized the Fed's independence. So, for example, during Trump's first term, he told the Federal Reserve, hey, I would really love it if you lowered interest rates. Because if you lower interest rates, that's going to cause a big economic boost, and that's going to be really great for my numbers for the 2020 election. And then I'll be more likely to get reelected. And this was all before COVID, right? COVID changed everything. And the Federal Reserve is like, no, we don't want to do that. That's not a good reason to do that. We're not going to increase, we're not going to, shift aggregate demand to the right and increase the money supply just to help you. We have these things that we care about. And these things do not include help the incumbent get reelected. Sorry, dude. And he was like, can I fire them? And no, you can't. They're independent agencies, right? They have no authority. By multiple layers of statute. They are built to be insulated from political pressure. Because that's the goal. We need to insulate the board members from political pressure, because we've seen in other countries what happens if we subject to them, then things go wild. Can't be trusted. Politicians can't be trusted. Any questions? All right. So, let's talk about how they do this. How exactly do they conduct monetary policy? I was telling you before that when a bank decides to lend money out, it's going to keep a portion of it cash on hand to cover deposits, right? Now that cash on hand does not occur within the bank. Any money that the banks want to hold on to actually goes to the Federal Reserve. Now, remember I said a central bank is not really a bank. The Federal Reserve can lend money out, but it can lend money out because it can literally just create money. Banks that put that money in, those deposits are not lent out. This means that anytime a bank puts money into the Fed, it is functionally taking that money out of circulation. It could borrow that money and start that whole chain of events for the monetary multiplier, but whenever it says, you know what, we're just going to put it in the Federal Reserve, that money is taken out. And the Federal Reserve holds it. The Fed pays interest on these balances, on these reserve balances. I'm going to call this IORB, for interest on reserve balances. So, this is the main way that they do monetary policy. If you want to engage in expansionary monetary policy, you say, hey, banks, we're not going to give you very much money if you keep the money here. And banks are like, oh, well, screw that. I'm going to take the money out. I'm going to lend it and make some real cash by lending it out to others. I should say this causes the money supply to go up, and that causes interest rates to fall. And AD shifts to the right. If, on the other hand, we're going to go into contractionary monetary policy, like what they did just recently in order to prevent inflation, they're going to increase those reserve balances. And banks are like, well, I'm going to put my money in the Federal Reserve. Screw you guys with your risk and everything. That's annoying. I would rather be paid by the people who can literally print money. That's pretty nice. And interest rates would go up as the money supply falls and aggregate demand shifts the other way. You might have heard of the Federal Reserve deciding to increase or decrease interest rates in recent years. This is what they're talking about. In fact, we have that data. Let's pull up the data. Oh, did it log me out? Work. There we go. I have to log back in again. Like a sucker. Hold on. Hard to type my password at this angle. Okay. Let's do interest on reserve balances. Right. And what you see are these very clear steps. This is a new system, by the way. This is why the data don't go back very far, because they started doing this 2021, roughly. This is what they call the abundant reserves framework. Interest rates were low, and they were like, oh, we have a lot of inflation. Let's increase our interest rates a bit. Because we weren't really sure if this was transitory, they weren't really sure if this was permanent. And then a little bit later, oh, this is hanging on for a while. And we're going to increase interest rates a lot. They stepped it up. Every single one of these represents the open market, you'll mark the board having a meeting. We meet multiple times throughout the year. Then you see it start slowing down. This is them trying to get that soft landing. We want to increase interest rates. We don't want to increase them so much we slip into recession. And now they're giving companies lots of money. This is why it becomes harder and harder and more expensive to get an interest rate, because people who are borrowing money from banks, they're trying to entice those banks away from just putting money at the Fed, which is riskless. And now we're starting to see them drop. They say, look, inflation has cooled quite a bit. It's not as bad as it used to be. It's not exactly what they want it to be, so that's why you haven't brought it all the way down. But it's a lot better. And this flat area represents, they've had some meetings since the last rate decline. And this represents likely they are not sure what to do, because we have a lot of uncertainty. We have a lot of tariff uncertainties. We might go into recession. We don't know. It's hard to tell what Congress is doing. It's hard to tell what's going on with the budget. There's going to be a budget in September. Maybe there'll be another continuing resolution. There's a lot of uncertainty. And still inflation, it's gotten a lot lower. It's not as low as they would like. I think it's around 3%. They're trying to get to 2%. But you can see things relate. Any questions, by the way? Okay. We have 2 more interest rates to discuss. Oh, it's all real. You have something called the federal funds rate, or FFR. And we have something called the discount rate. One of these is the rate at which banks lend to each other. If, for example, they're a bit shy on cash, and it's like, oh, we really want some more money in order to make sure that we can cover our withdrawals. You know, some people will have automatic payments set up, and they're paying their phone bill or their water bill, and that money gets taken out like 2 o'clock in the morning. We want to make sure we have that cash there. At the same time, some companies happen to have extra cash, and so they will lend money to each other to cover this rigidity. So one of these is that. The other one is the rate at which you can borrow money, and by you I mean banks, can borrow money from the Federal Reserve. Which do you think is the one that's between banks, and which do you think is the one from the Fed? Yeah.
FFR is from the Fed.
Yeah, you would think so. It's not. The federal funds rate is the rate at which banks borrow from each other, and the discount rate is the rate banks borrow from the Fed. It was called the discount rate because the idea is the Federal Reserve wanted to be a lender of last resort. And you can go to the Fed and get like this discounted rate if you really needed to. The idea was banks would be hesitant to do it just because if you're borrowing money from the Fed, that kind of smacks of desperation in the bicycle. So they were the lender of last resort. So the discount rate, that's where we get that term. Why the hell is it called the federal funds rate? Even though it's not really about the federal government. Well, because it is, actually. So remember how we said reserve ratio? There was a portion that banks kept cash on hand in order to cover withdrawals. It used to be called the reserve requirement. The Federal Reserve set a requirement that you had to have at least 10% of your deposits to cover withdrawals. And so banks would make these overnight loans. Hey, I'm only at 9 3/4. I need to like students trying to do homework at the 11th hour. Could you spot me the rest of the money so I can hit this requirement? And some banks have to be a little flush. They have to be over that 10%. Like, sure, but it's going to cost you. And that's why it was called the federal funds rate, because it was to help banks comply with this Federal Reserve requirement. So both rules are kind of old. Like, banks will still borrow from the Federal Reserve, but that's not the main way they do monetary policy. This is a market rate. This is one set by the Fed. And you can see that in the diagram. Because if I edit this graph, and I add a line, and I go for federal funds rate, and add that data series. Oh, I'm sorry. They do a stupid thing where they default by making the new line is now this green dotted line. Like, some people want that for some reason. It's really weird. And we're going to bring this down to, we'll see. Okay. You see they follow each other. Because if I'm a little shy and I'm like, ooh, I would really like some more money to make sure that I can cover my withdrawals. If I'm going to entice a bank to lend to me for an overnight loan, I have to compete with the Federal Reserves. So they operate in tandem with one another, but the green is the market rate. Yeah.
How does the Federal Reserve's rate end up being a discount? Follow each other.
Well, no. So there's also the discount rate. So this is IORB.
Okay.
But that's different. That's the money that the Fed will pay. This is the rate. And so let's add I believe we have a discount rate. Interest rate discount rate in the United States. Discount window primary credit rate. Maybe that's the one I want. Oh, and also defaults to a line. Freaking, who the hell wants a dotted line? That's so unreadable. Line 3, customize. Solid. Thank you very much. And we are going to then also adjust this to you see that also steps up because it's just set. So when they increase IORB, they also increase the discount rate by the same amount. The Federal Reserve has those tools at its disposal. It can also buy government bonds and sell government bonds in order to put money into and out of the system. That's the way they used to do it. It was called open market operations. But now it's all about IORB. They still do open market operations. So I do want to bring that up. I also want to emphasize the Federal Reserve does not set interest rates. And by interest rates, I mean the interest rates that you and I incur. It influences them. Just like it influences the federal funds rate, but it doesn't set them. It doesn't say this is exactly what it's going to be. Does anyone have any questions? Yeah, David.
What did the banks go?
Well, so if the banks, before when they had that rule, if the banks did not meet their 10% requirement, they would get a fine. Right? They had every incentive to make sure they didn't make that mistake. But in the abundant reserves framework, there's no requirement. Right? It's been going away. It's gone away completely. And rather than it's essentially imagine before the Federal Reserve used a stick hey, make sure you have enough cash in hand, or we're gonna beat you with the fine stick. And now it's a carrot. It's, hey, you want to put your money over here? We'll give you some more if you put it over here. Plus, like the the banks already have an incentive to have cash on hand because, like, imagine you do a withdrawal from your money and it's refused, not because you don't have enough money in your account, but because the bank ran out of money. Like, you would be pissed, right? So banks are not banks are going to make sure they have enough cash. Right, like we can imagine a situation. And worst case scenario, if they don't have enough cash, they can borrow from the Fed. They don't want to do that, obviously, but they can. They can borrow from other banks too. They don't want to do that. They don't have to, but they can. All right. Yeah, 15 minutes. Don't worry, we're almost done. I saw some people yawning. I know this is a lot of information. Very end. Any other questions before I give you the very end? Very end is the challenges. Monetary policy avoids some of the problems of fiscal policy, but monetary policy also has not perfect, it's not without problems. And some of these challenges are going to overlap with fiscal policy. And there's a really big one that has complete and total overlap. Kervin, do you want to guess what it is? Take a look at our list of weaknesses of fiscal policy. What do you suppose monetary policy is also going to have? Which challenge? So keep in mind, well, why do we have that legislative? We have a bunch of politicians who have to get together and make a decision. How that issue over here. Yeah. So keep in mind, like, this is all about borrowing money. And the Federal Reserve is all about making it easier to borrow money, right, for everybody, right, because they put more money in the system. This assumed, like the demand side crowding out, assumed that we had a fixed amount of money. What does fiscal policy do? What does it shift? Aid to demand, right? What does monetary policy shift? What was that? I heard it? AD as well, right? And so, what do you think one of the big things it has in common?
Lag.
It does have lag, though, as we'll talk about, it's not as bad. It can't handle real shocks. The COVID was a real shock. Not just surprising, but also it shifted LRS to the left. And I remember when that happened, the Federal Reserve is like, oh, you're supposed to keep unemployment low. I guess we're going to lower interest rates? Because that's what we can do. And I remember thinking, like, well, that's not going to do anything. It was, like, great for some people. Like, we financed our mortgage, right? But, like, the problem was not, oh my goodness, if we just get some more people investing in some factories, that will solve the problem, right? The only way to handle real shock is another real shock. And so monetary policy can't really do anything about that. It's just playing around with interest rates. It's just shifting AD. So if we have an LRIS shift, we're done. Sorry, dude. I mean, they'll still try. Okay. But someone else noted another thing, lag. Here's the thing with monetary policy. It also has lag, but its lag is less extreme. Monetary policy has lag, but its lag is less extreme than fiscal policy. It only has 2 of those 4 items. It only has 2 that actually affect it. Somebody suggested legislative lag, but keep in mind, how many members of Congress are there? 535, right? 435 representatives, 100 senators, then you throw in the president in there. It's really hard to get all these people to come to a decision. That's why it's so slow. Plus they have all these different competing interests and everything. The Federal Reserve, though, is made up of like just a handful of people on the board of governors. I can't remember how many because there's like a maximum, but this people rarely serve out the 14 term. So currently, Board of Governors for the Federal Reserve is, let's see, here's the board members. We have 1, 2, 3, 4, 5, 6, 7. There are 7 people. Christopher Wohler, Adriana Krugler, Lisa Cook, Michelle Bowman, Michael Barr, Philip Jefferson, and one name you might know, Jerome Powell. So they have 14-year terms. One of the members serves as chair of the Federal Reserve and acts as spokesperson and so forth. So that name that you heard, Jerome Powell, chair of the Federal Reserve. They serve in 2 4-year terms where they are nominated by the president, confirmed by the Senate. Jerome Powell's term is going to be up soon, actually. So we will get a new Fed chair in, I want to say in next year. I think his term is up next year, 2026. A lot easier to get these people on the same page, right? They have a meeting, it lasts like a day. Okay, so we're not going to worry about legislative flag. What we got 3 others. Want to take a guess? Yeah, go ahead. Recognition, yeah, recognition still applies. Why? It takes time to recognize this problem, right? Yeah. Right. That long time, those breaks that they have with the stepping up, that's the Federal Reserve looking at the data, trying to figure out what's going to happen. Like them, right? It takes time to look at that data. It takes time for the data to be gathered. We could be in a recession now. We would not know because we have to get the data first, right? To confirm, right? We would maybe know. We hear about lots of losing the jobs and so forth, right? That's indicators, but you actually don't know the magnitude and the details until you get the data, and they need that data in order to recognize this problem. So you're still going to have a delay. If the problem is huge, the delay is going to be pretty small. But if the problem is on the small side, the delay is going to be rather large. Yeah. Effectiveness is the other one, absolutely. It's still once they implement this and once they cut interest rates, it's still going to take time for investors to apply these new interest rates and for that effect to be felt in the economy, right? Like if you're going to lower interest rates, it's going to take time to identify people to lend to, and then those people have to put the money in, and then the multiplier still has to have an effect. So it still takes time for all that to have an effect. It's a different mechanism, but it's the same story. All right, so it seems like monetary policy is strictly better, but monetary policy has some unique problems. Do you remember when we did 1 over MPS? And I was like, well, it's not going to strictly be that. There's all these other considerations. That said, I don't really think politicians care too much about the multiplier. Not in that exact term. They're not. I have a hard time believing they are pulling out the data, trying to figure out what the multiplier is, and that's going to directly influence how much money to spend. They have other pressures to worry about. So the fact that they care about the fiscal multiplier doesn't seem likely to me. But the Federal Reserve is all about people who are, all of them are economists. And they certainly do care about the monetary multiplier. But like the fiscal multiplier, the monetary multiplier does not strictly equal this. This is a good starting point. But when you get a check, do you always put 100% of your money in the bank? No. I don't know, right? What else do you do with it?
Spend it.
You spend it. Well, yeah, when you spend it, you're just giving it to a company, and the company's going to put the money in the bank. But there's something you also can do with your money that doesn't involve banks at all. Well, then that just goes to somebody else, right? Because you buy an investment, and someone's going to be on the other side of that transaction, and then they will have money, and they might put it in the bank. David,
You take it out with cash.
take out cash. Right? You have cash, right? How many of you have cash on you? Few of you do, right? Sometimes it's just handy. Sometimes it's just easy. Some businesses only take cash, right? My barber only takes cash. Right? They're cash only business, which means that money is not in a bank, which means that money is not being multiplied. And so one of the things that complicates the Federal Reserve estimations is the demand for cash. And because they're economists, they actually do care about that, of trying to get that multiplier right. They are actually considering what is the demand for cash, because we want to better estimate what that multiplier is, because we do not want to overshoot or undershoot. Central banking is hard. Have you ever heard of the envelope method for saving? Yeah, what's the envelope method? Yeah, you nodded your head so slightly, I saw. Oh, I've never heard of that version of it. I was thinking of you mark the envelope with different, like food and gas. No, okay. So this maybe it's not a thing anymore, but there was this strategy of saving money where you budget, and as a way to constrain yourself, you say, this is my budget for food, for grocery shopping. And you would label the envelope food, and then you would take that amount of money in cash and put it in the envelope. And whenever you went grocery shopping, that's how much money you spent. And if you ran out of money in the envelope for the month, you can't spend any more money on grocery shopping, right? It was a way to sort of force people to do that budget. I think about this here because when that method was really popular, that increased the demand for cash. Because now people are taking money out of the bank account and putting it in these envelopes in their house. And I bring it up because it emphasizes all the different considerations that can go into, like, randomly, this finance person is suggesting as a way to save money to take your money out of the bank and keep it in cash. And if that becomes really popular, that's going to suddenly influence this. And that's going to substantially adjust this. And it's going to make it hard to do monetary policy. Last challenge is a liquidity trap. I'm just going to erase this. Liquidity trap. How did this go again? If you bring I or B down, that will put more money in the system. That will cause interest rates to fall. And that will shift aggregate demand to the right. But what if interest rates are already low? How low can interest rates be? 0, right? Yeah. Imagine interest rates are negative. I'm going to put money in the bank, and then I'm going to take less out. My amount of money is actually going to decline. Or I'm going to borrow money from the bank, and then I'm going to pay them back less than that. That does not work. And if there's a lot of money in the system, interest rates can get so low that adding more money will not cause interest rates to fall. There's a lower bound. at or near lower bound, then you can't make monetary policy work anymore. This connection falters, and this doesn't happen. Expansionary monetary policy stops working. So we know what liquidity is? Helps understand what liquidity trap is, if you understand what liquidity is in finance. Yeah.
Isn't it like how easy
Yeah, exactly, right? And it's just like a liquid, right? It takes the shape of its container. And so and cash is the most liquid form, right? It's cash returned. So a liquidity trap is just there's too much cash going around. There's too much potential savings out there in the economy. And you might say, I want to borrow money. You'll have tons of people who want to lend you money. Because people are all looking for it to work for them. Even at very, very small amounts. The small is better than nothing. So putting more money into the system is not going to help. Now, during the Great Recession and during the COVID recession, the Federal Reserve tried to get around this with something called quantitative easing, which involved buying assets from financial institutions, not just government bonds, but any kind of asset, freeing them up, freeing these troubled investments up, and giving them yet more cash to lend out. It makes the existence of the liquidity trap controversial, but QE has its own problems, such as encouraging banks to take on excessive risks. Buying non-bond assets. So it doesn't really result in a liquidity trap because you're literally freeing up capital, like you're removing risk from the bank's balance sheet. But can incentivize risk. Remember, the greater the risk an asset has, the greater the rate of return. There's a risk-return trade-off. A bank might say, let's take on a lot of risk. Because if there's a recession and this doesn't work out, the Federal Reserve will just buy the risk from us. And we don't actually have to worry about it. If you remember, did anyone watch The Big Short? Because I think I mentioned it before. No, so The Big Short was all about this bet that housing prices would fall. It's a great movie. And it actually happened, right? That there were people who thought that housing prices would collapse and that there would be all these toxic assets that banks had. And they made a financial bet that would happen because when it happened, they would collect tons of money. And they were like, why are banks doing this? Why are banks lending money to people that really probably can't pay it back? This is not going to work out well. And they did make a ton of money when the market finally turned against them. But toward the end of the movie, the people making the bet realized that the big banks were having meetings with the Federal Reserve. And the Federal Reserve was buying these toxic assets. And they were like, you knew this was going to happen. You knew that you would be saved. It's like, yeah, that's fine. In the attempt to save banks, to prevent a 1930s depression kind of problem, you also will incentivize excessive risk-taking. In economics, we call this moral hazard. It goes beyond the scope of this course. You can cover it in 202 in great detail. But That's the trade-off. The other side of the liquidity trap is if we are in a liquidity trap, that means interest rates are low. And if interest rates are low, government borrowing is really cheap. And fiscal policy, despite its flaws, suddenly seems like a better idea. So economists who really love fiscal policy are quick to argue the multiplier is huge and are quick to argue that interest rates are so low we're in a liquidity trap. And monetarists are quick to point out that, well, fiscal policy has these crazy problems with it, and we should really do this, and maybe liquidity traps aren't really that big of an issue because we can do quantitative easing, but if you do quantitative easing, you might cause these longer problems for the economy because you're changing weird incentives. There's a lot of trade-offs. It's not obvious what to do, but that's the essence of economics. Does anyone have any questions? Okay, that's it.